Hey everyone, I'm going to be talking about why the next 1, 2, and 3 years matters the most for your property investing. So whether you're brand new or whether you already have investment properties, the next few years are going to be critical, and this video will go about telling you exactly how you can capitalize on them.
Do you want to achieve wealth and passive income through property investing? PK Gupta, host of Oz Property Investment Mastery, will help you achieve passive income by buying top 5% growth and positive cash flow property and building a portfolio using data without you wasting months of time doing research, spending weekends at inspections, or dropping $10,000 to $20,000 on buyer's agents each time. So if you are confused and overwhelmed by the amount of contradictory information available online and don't know where to start, then this show is for you.
Now, often people think that how hard can it be? How hard can it be to buy investment property, right? Like in the long term, it will do well. And that's true. And if all you want to do is buy one investment property and have it go up after 10 or 20 years, then to be honest with you guys, you don't really need me. You don't really need anyone else. It's not that hard. And the reason is basically every place in Australia performs very similarly regardless of where and when you buy. So let's prove that for a moment. Regardless of where you buy, regional capital cities, anywhere at all, basically everything goes up between 5 and 7%, but you should never trust me blind. You should never trust anyone blindly. Everyone is an expert on property. So let me qualify my opinion. I've got a table in front of me, and I'm just going to read you some statistics. So Sydney from 1990 to 2020 has gone up 5% per annum on average. Melbourne 5.7, Brisbane 5.2, Adelaide 5.3, Perth 5.3, Hobart 6.1, Darwin 5, and Canberra 5.7. Regional areas, we're talking like Newcastle's, Bendigos, the Ballarats, the Oranges, the Hobarts, Launcestons, the Gold Coast, the Sunshine Coast. All these regional areas, Cairns, they've all gone up between 5 and 7% as well over the last 30 years. So the next few years are critical. The next few years are critical. And the reason for that is that property markets don't grow in a linear fashion, right? So just because I've just told you that Sydney market grows at 5% per annum doesn't mean that every single year it's going to grow by exactly 5%. It goes up, there's booms, there's drops, there's plateaus, there's steep gradients, there's shallow gradients on the up and the down. It's not circular, it's not cyclical in a perfect round way. So the way that mathematics works is that if you want to develop a passive income of 6 figures, let's say in 10 years, 15 years, 20 years, you need most of that growth to be skewed at the front end of your ownership of that property or portfolio. Okay, in the long term, everything will do well. But if you want to accumulate assets quickly, you can't afford to buy a property that will be flat for the next 5 years and then have a boom and then be flat again. Because think about this. Let's take 2 examples. One investor buys in Brisbane, let's say in 2011, and another investor with the same amount, let's call it 400,000, buys in Newcastle, let's say in 2011. So they're both investors with $400,000 to spend in terms of their first property purchase. One person buys in Brisbane, one in Newcastle. Let me illustrate this point of why short-term growth is so important and why the next 2 or 3 years will give you this opportunity. The person who bought in Brisbane, like for the last 10 years, Brisbane property prices, detached homes, detached dwellings have grown by about 20%. Right? So that investor, even after 10 years of holding a freestanding freehold property in a capital city, has made 20% on $400,000, right? They haven't even cracked enough equity for another house after 10 years. Now take another investor who said, okay, well, I'm not just going to follow the herd. I'm not just going to go by what these property experts say. I'm actually going to follow the data, and they bought in Newcastle. So that investor in 3 years, or in 2 years actually, would have had enough equity in Newcastle to have bought another 1 or 2 investment properties. In 2 years in Newcastle, you would have made at least $100,000. And then after 2 or 3 years in 2013 or 14, they, let's say, bought in Hobart. In another 2 years, they would have made another 150, 200K, right? And then you would have used that money to then buy in a place like Geelong around 2016. In 1 or 2 years, once again, made $100,000, $200,000, and you buy in a place like Ballarat. And once again, we're all talking sub $400,000 purchases, by the way. And then in a year or two, you've made $100,000, $200,000, and you buy in a place like Orange or Albury or Bendigo. I'm trying to make the point, right? That first investor started with the same capital and wasn't able to grow his portfolio. The second investor started with the same capital, was able to build his portfolio of between 5 and 10 properties in literally 10 years. Now, that first investor could have been many of you guys, I don't know. That second investor, that's exactly what I did, right? So not buying in a capital city for the sake of it, because the data shows that capital cities don't outperform regional areas, right? The data shows that regionals don't outperform capital cities in the long term. It's about the next 2-3 years. That's where we want to focus our attention, because that's how we build our portfolio. If I had invested in Brisbane, which is where I live at the moment, 10 years ago, I would not be making these videos, because I would have been sitting on a property, basically a dud, thinking property investing doesn't work. Instead, I'm sitting here just over 10 years later with 120K passive income, telling you that it's possible to buy 8, 9, 10 properties in 10 or 12 years by following short-term data methods, by following markets that will grow in the first 1, 2, 3 years. And I know what you're thinking. You're thinking, all right, PK, well, get off your high horse. Back then, it was possible to buy properties under $400,000. Right now, it's not possible. That's what you're thinking. But really, I'm here to encourage you to say, I've just made the point that over the long term, regional areas perform just as well as capital cities. There are countless regional areas right now that you can invest in outside of Sydney, Melbourne. In fact, you don't even need to go regional. There are capital cities that you can invest in under $400,000-$500,000, where you can replicate exactly what I've done, where the data stacks up perfectly for $100,000-$200,000 growth in the first 1 or 2 years. You can take that equity, buy again and again. Don't have a myopic view of just buying in Sydney, Melbourne. Don't have that view, right? And I just did a video on how apartments make for very poor investment decisions. Apartments are seldom good choices to buy. I know what you're thinking. You're probably thinking, all right, well, I'm not really sold on this whole regional story, despite what the data says. All I can afford is an apartment. Well, here's why you shouldn't do that. Once again, don't listen to me. Here's the data. I'm going to share with you some data that will dispel your want to buy an apartment. I know what you guys are thinking. You guys think that, wherever the shops are, wherever the schools are, wherever the cafes are, wherever the water is, wherever there's lifestyle components, convenience factors, that is where makes for a good property investment. And why not just buy an apartment there? Like if you're in Sydney, you're probably thinking, what's wrong in buying an investment property, an apartment in Bankstown or West Ryde or Westmead or Epping or Hornsby or Strathfield? Well, let me share with you some data. In New South Wales, if you bought in Bankstown 5 years ago, you would have made a total growth, not average, a total growth of 6.5% in an apartment over the entire 5 years. That is not enough to get you that second, third, fourth property. You need 150K growth in the first 2 years to make an investment property worthwhile. That's really the litmus test of whether you've conducted elite property investing. West Ryde, the total growth in the last 5 years was 7.7%. Westmead, like a nice area, right? Negative 3.7%. Epping, 9%. Like even 9% or 10% after 5 years is peanuts. That's not what we want. Hornsby, 0.6%. Strathfield, 4.7%. Burwood, 1.8%. Haymarket, negative 8%. Castle Hill, really nice place, good mall, all that kind of thing. Everyone wants to live in Castle Hill. Apartments, 2.5% growth over the last 5 years, like ridiculous. Homebush, 0, nothing. Nada. Auburn, -2. And if you're in Victoria, let me give you some Victorian stats. So Abbotsford apartments, we're all talking about $500,000, $600,000 apartments here on average, maybe a little bit less in some suburbs. 13% in Abbotsford. 13% growth in 5 years is really not setting yourself up to extract equity and buy again and again. This is a really terrible result. South Bank, -2%. right? I've just done a video on why apartments are lousy. Go check that out. But here's the proof again. Doncaster, negative 0.1%. So once again, I want you to take away from this the fact that, long-term growth is always going to be there. You don't need to be a rocket scientist to figure out that. But short-term growth is what we need. It's imperative. But don't make the mistake of buying an apartment just because you don't have $600,000-$700,000 to spend. All the properties that I've ever purchased residentially are under $500,000. You can do this in capital cities. You can do this in regional areas without having to buy an apartment. All right. So look, what can you do right now to actually put this into action, right? The key takeaways that I've already shared with you are long-term growth is great, but you need short-term growth. You need that thing to go up by 100, 150 in the next 1 or 2 years to be able to take equity, because that is how wealth is created. Generational wealth is created over decades. But if you want to leave your job or have flexibility or just want to spend more time with your family in 10 years, 15 years, 20 years, you need each and every property to grow in the first 1 to 2.5 years whilst being positive cash flow. That is an imperative. That's just something you need. It's not like we're in the 1990s, right? It's more difficult these days. That's just the harsh reality. So the first thing is chase short-term growth. And you won't get that by following infrastructure trends or by following population growth or by following migration trends, all that kind of thing. Brisbane had the biggest population growth of almost any capital city over the last 10 years, but like I've just demonstrated, capital growth of 18%. Those two things aren't correlated. So the first thing is you need short-term growth. That's the first takeaway. The second takeaway is don't limit yourself to Sydney and Melbourne. You're not going to get positive cash flow there, and you may not get short-term growth in all instances. Be open to buying regionally. Don't make the mistake of thinking regional underperforms. It doesn't over the long term, and there are countless regional areas that will make you more money in the short term than you will make by buying in Sydney or Melbourne. Number 3, don't buy in apartments. Just because you don't have $400,000, $600,000 to spend doesn't mean you need to go buy an apartment because it's cheap, right? You don't need to do that. Apartments underperform. I've proved that. Stay clear of apartments. Now, how do we take these 3 principles and put them into practice? Well, the first thing is you need the right team. To buy interstate, to buy borderless, you need a conveyancer, mortgage broker, quantity surveyor, accountant, and a property manager or property managers around Australia. That is essential. What you don't need is a buyer's agent, all right? A lot of times buyer's agents say you need a team, and they kind of conveniently slip in the fact that you need a buyer's agent. You don't need a buyer's agent. All of this can be done remotely without a buyer's agent using data. The second thing you need to implement the first 3 principles is you need to understand true data. Now, by true data, I mean things like inventory levels, days on market trends, stock on market percentages, developable land supply schemes, building approval schemes, job advertisement trends, all these types of things, not just yields, not just historical growth, not just vacancy rates. Those are very simple things, guys. Don't make your property decision based on those simple factors. And the third thing you need to unlearn the fact that you should be buying properties based on the market sentiment, or based on how much infrastructure is going in, or based on whether the economy is thriving, or the workforce is increasing, or whether it has a good lifestyle appeal or migration trends. Those things impact long-term growth. It's not that they're not important. They impact long-term growth, but long-term growth is there anyway, basically anywhere you buy. I just proved that at the start by sharing with you some statistics around Australia. So long-term growth kind of takes care of itself unless you make a massive mistake. And that's not really hard to avoid making those mistakes. But the way that mathematics works is we need the majority of our capital growth skewed to the front end of our acquisition phase, skewed to the start of your property investment journey. Because the way that arithmetic works is that any growth upon more growth in the short term is more. Okay, I'll just say that again. Growth that happens on earlier growth is more. All right, that's just the definition of compounding. Right, when you get initial growth, then any future growth, which will happen anyway in the long term, like I've said, will be more because you've had initial growth. So if you want to buy multiple assets, you need to buy your first investment property or your next investment property that will have short-term growth so that you can take equity and then you can build You can build a portfolio, buy multiple assets, and then future growth will always be there. But we need to quickly buy investment properties to build an asset base that will start multiplying in value because of the rule of compounding, right? But you can only get that if you follow true data, not stuff like infrastructure that only kicks in after 5 or 10 years. We need that short-term growth. So hopefully that's all making sense, guys. Like, I'm sharing this with you from experience. I know this is very contrary to basically what everyone says, all the buyers agents, property investment companies, all that stuff, because it's very easy to sell you a story that, oh yeah, big shopping center coming in, Bunnings coming in, Westfield coming in, all this sort of thing happening, growth corridor, population trends, buy here, buy brand new house and land package, duplex, Ipswich, Logan, North Lakes, Narangba, all this kind of thing. It's very easy to say that, but that's not going to serve you. What's going to serve you is by telling you the truth. The truth is a little bit more difficult than what people make it out to seem. But you need, in this day and age, we're not in the 90s. You can't buy 200 properties in 2 years. We're starting in 2021. You need every single property to grow in the short term and be positive cash flow. In the next few years in real estate in Australia afford us the perfect opportunity where there's plenty of regional areas and secondary cities that are booming, that are about to boom. And really, there's no excuse for you not making $100,000 this time next year if you follow the data. All right, guys. Well, hopefully that is awesome. Happy investing and peace.